G'day everyone and welcome back to this Share Cafe Hidden Gems webinar. Now before we make a start, there's always some things we like to point out in the markets. Now this week we've been enjoying the success of Lake Resources and watching that EV battery theme play out across the world with all the talk about energy transition. We've also been looking through the mechanics of the coal contract pricing. We're watching Marley Spoon with the share price under pressure. It's down about 65% versus HelloFresh, which is up around 75%. The content we're looking at creating is looking at that vanadium battery versus the lithium battery. We think that's something of interest. We'll create some content on that next week. We're also watching Next Investors as they try and pump the Vulcan share price post JK Capital producing negative research, and that was something that failed dismally for Next Investors. We're also seeing massive inflows into equity markets. It was around $24 billion, which was the biggest inflows since March this year. So if you've got some questions, don't forget to type them in the box provided, and also watch out for our webinar next week, which is on our due diligence webinar, which happens every fortnight. That'll be on Tuesday. That's on Carzia Therapeutics. Okay, let's make a start. First up, we have BlueBet, ASX code BBT, market cap of around 380 million. Doesn't have a one-year return, only listed in July this year. We have with us Bill Richmond, who's the CEO. Now, BlueBet is a profitable, debt-free Australian wagering operator, which has been self-funded since its establishment and has a track record of strong growth. Bill, thanks for your time. Over to you.
Thanks, Tim. You stole a few of my lines there, but BlueBet's been running for around 6 years. As Tim said, we're an Australian wagering operator. While we've been operating for about 6 years as BlueBet, the majority of the management team have worked together for significantly longer in other successful Australian wagering businesses. As Tim said, until IPO, we were totally self-funded. And really in those early days, it was about us building the foundations of a strong betting company. And we're really looking to turbocharge that growth now that we're using some of those funds from the IPO. So if you just slide forward one slide there, guys. And this is a bit of an overview about us. As we've got our own technology platform, it's very scalable, which has been very important as we've seen the business grow significantly over the past couple of years. Not only can it handle the growth that the business has had, but it also means there's very limited adding to headcount, as it's a lot of autonomous processes during the process. We have very much a dual growth strategy, which is continuing to grow the Australian business. As mentioned, we only have a little over 1% of the market here, and we're profitable at that point. So there's enormous room to continue to grow. And the great part about the business, as I mentioned, is the scalability of it means that a lot of that flows straight through the bottom line. We've had a significant step up in marketing costs post the IPO, which is part of really trying to turbocharge the business. But other than that, really our costs stay pretty fixed. So there's a great opportunity to grow the business and continue to grow the profitability of the Australian business. The other part of the growth strategy is this Greenfield Opportunity in the US. It's very unusual that the US is such an open opportunity, but essentially sports wagering has either been illegal, or it's been illegal there in most states. So it's been either underground or offshore. So it's a really exciting opportunity. It's really only been in the last 2 to 3 years this opportunity existed. And we have a strategy for entering that market. It's a capital light strategy, but we think it allows us a great opportunity to access it without taking an enormous risk. The wagering industry as a whole has been growing. The Australian market has continued to grow. Australians are some of the highest bettors in the world. And the US market has continued to grow off a very low base. But certainly the estimates have been, I think it's been underestimated the size of the market. And I'll show some slides on that a little bit later. Let's go forward a couple of slides there to slide 4. This is having a look at our key metrics versus the prior corresponding period for our financial year 21. We had really strong growth. As you look across our bet count, our net win and our turnover there, all up between 80 and 95%. 6.5 million bets, 35 million net win. And that flowed through to a normalised EBITDA of 7.5 million, which was up close to 50% on the PCP. Our net win margin at 10.3% last financial year, really strong in this industry, compares very favourably, and certainly that's flowed through into this financial year. We had a really strong first quarter, which I'll talk about in a second. As I mentioned earlier, we hadn't spent a huge amount of marketing in previous years. It's really only over the last year or two that we've really started to step that up. The cost of our first time deposit there at $214, again, is really strong in this industry. And you compare that against the annual customer value of $1,095, shows that we're getting a really strong return on that investment. It gives us great confidence as we continue to grow our marketing spend, that we're going to continue to get a really strong return on it. Let's go to the next slide there. Having a look at our product mix, we've seen really strong growth across our product range in Australia. Sport has been slightly affected over the past year or two due to COVID and the cancellation of a huge number of events. But where we have seen some really unusual strong growth is in things like greyhounds, which is probably an industry that most people don't necessarily think of. And a lot of that's down to our mobile first strategy. Everything in this company, we think about mobile first. When I say that, I mean using a mobile device rather than a desktop or any other sort of way of people having a pet. We don't do retail. We're 100% online. 66% of our bets are taken through our mobile apps. That's our native apps, and of the rest of which is all pretty well web traffic. The majority of that's through mobile devices as well. There's been some limitations, particularly with Android. Previously, Google hadn't allowed gambling apps in the Play Store. That changed in March this year, so we've seen significant growth in Android traffic. But really, that mobile, people betting on their mobile is the foundation of the business, and that's a big part in seeing growth in areas like greyhound racing and harness racing, which are at night, and it's a very recreational product, which we derive really strong margins from as well. The sport, we continue to see growth. We've run there, in the last financial year, around 14% sport as turnover. We'd expect that to rise significantly over the next few years, normalising somewhere around 20%. And the sport margins, been really improved in recent times by the introduction of some new products like Same Game Multi, which has been very appealing to the younger audience as well. Moving on. This is just looking at our Q1 metrics at the quarter just ended in September. Again, really strong growth again, across all these metrics. Active customers, turnover. We had a really strong margin quarter-wise at 11.8% net win. That's not something that we'd budgeted for, and it will normalise over the year. We'd expect that to normalise around that 10.3 to 10.5 mark. But certainly a really strong quarter, which has really showed the momentum has continued from last financial year, and that's continued on to what's been a really strong spring carnival for us. This is obviously a tremendously busy time of year for the business, and all our technology's held up really well. We had a new website launch just before the carnival, again held up really well, and we've got new apps coming later in the year as well. So the business is continuing to grow, and as we've come out of lockdowns, we've seen that a lot of those customers who came across, we didn't see necessarily huge growth in wagering in Australia during that period. What we did see is a really accelerated migration to online, and that's certainly continued post the lockdowns. The next slide just shows continuous growth in our active customers across the quarters. Really speaks for itself, so I won't linger on that too long as we look to get to Q&A. From a marketing point of view, for looking at the next slide there, we've had previously we had a really strong focus on below the line digital. We've changed that up with our first major TV campaigns from that money that was raised during the IPO. They've been successful for us. As an Australian betting company, which is quite unique in this market, a lot of the bigger operators are overseas, and we've certainly really honed in on that. We've had a strong focus on regional customers and on pay TV with our new above the line campaign. And that's certainly, we've been very happy with the results from that. The next slide just looks at some of the below the line activity that we do. It's certainly been the foundation. Again, that mobile first approach really strong. People, in-app advertising, in-app search, those sorts of things really generate the sort of customers we're after, and we get a very solid return and pretty guaranteed return on our investment in those. So that remains a major focus for the business. Looking across to our US market entry, The Australian business is really all about scaling our current business to continue to grow. The US is a totally new opportunity. Previously not legal, now legal in 22 states, operating in 22 states in different levels. Some's mobile, some's retail, but certainly we expect that number to continue to grow. There's been, estimates from analysts from anywhere between over 40%, over 40 of the states in the US, and potentially up to 96% of the population by 2025. A number of the big states haven't come online yet: California, Texas, New York, Florida. So certainly there's a lot of movement there, but it is a wonderful opportunity for a company of ours that, it's got a great history in running profitable sports books and also building all our own technology, which is one of the great shortfalls in the US market. It's surprising that, but because they have no exposure to it previously, it is a great opportunity for us to use the years of knowledge that we have here. The next slide just talks to the opportunity around what I was talking about before. If you look at those forecasts, you can see at every point they've essentially been underestimated. There's a couple of different models down the bottom right corner there about what the potential market can get to, modelling on the US and UK market. And the headline probably at the bottom there is Goldman Sachs have said at maturity it could be a $39 billion industry. But the Morgan Stanley data in the top right corner there just shows that they've continued to raise their estimates of what this market could be worth. So certainly it is a tremendously exciting opportunity for a company such as ours. Our strategy with the US, which is the next slide, slightly different. In Australia, we run as a straight B2C wagering provider. In the US, that is not our long-term strategy. There's huge companies going in there spending fortunes on customer acquisition. It's not something that we want to get in competing with them, against them. They have deeper pockets than us, and it doesn't make sense for us to do that. We are going into a select number of states as a B2C wagering operator, but really that's to prove the capability of our team and our technology and our product in the US market, with a long-term view of really doing partnerships with existing US entities who have their own brand, who have their own databases. So what we would be doing with what we're calling a sportsbook as a solution is really going and doing all parts of the sportsbook for them. That's from customer onboarding to their client verification to their banking fraud, but most importantly, that trading platform and our trading team coming in and running the operations for them. We've got a number of targets for this, mainly around that small and mid-tier casino operators who have a number of licenses in the US market, but they don't have the history or the knowledge on how to run a profitable sportsbook. So a number of them have gone down different paths with that, trying to run themselves using off-the-shelf platforms. But really what we think we can provide for them in the US is a best of both worlds strategy, where they have part of an asset growth. They own part of the asset, but they also have the advantage of having our knowledge and our technology, and our technology to have a unique and quality product in the US market. So that's Tim. That's probably my 10 minutes up. So I'll throw back to you for any Q&A.
Excellent, thanks, Bill. Plenty of questions. Can we start with how much did you raise in the IPO, and where are those funds going to be allocated?
Yeah, so of the $80 million we raised in the IPO, $50 million went back into the business. $10 million of that went to a real step up in Australian marketing. And the great thing about that is the business has now grown to a size where it can maintain that growth in marketing year on year. So that's really been a positive of that. The majority of it has gone to these US, setting up US offices, licenses, and some marketing in these initial states. And then there's another portion that's gone to continued product development. Product is really everything in this game. Everyone bets on the same thing. Everyone bets on the football or the races. There's not a great deal of differentiation at that point. So it's really about the user experience that's so important. So, we've certainly put a good chunk of those funds into continued platform development as well.
Yeah, be pleased to know I'm an Australian customer. I love your commercials. So a lot of people online would understand the Australian market. It's obviously very competitive. Can you give us more insight into the US market? What's your kind of timing around launch, and then maybe some more insight into the regulatory environment? It seems like it's a state-by-state proposition.
Yeah, so that's exactly right. It's state-by-state license. In Australia, we have one license out the Northern Territory, allows us to bet anyone around the country. In the US, you need to be licensed in each state. So we will be going live in Iowa as our first state, which will be in March next year. Iowa is the smaller state. And there's a number of reasons why we've picked these states to go into on a B2C basis, which is around, they all have different taxation rates, different licensing costs. So we've certainly picked the ones that we think, have a clear path to profitability. And, we don't, there's new opportunities appearing all the time with new states coming online, but you do have to satisfy, as you mentioned, licensing criteria in each state. And also some states require you to do deals with other license holders, what's widely termed a skin agreement. So that's something we've done in Iowa as well.
And what does a partner look like? Like you provide the technology, who is that partner?
So probably long-term, there's a number of options. The most obvious is casino operators. And it's a model that's been used by a number of the bigger people. Entain, who are a huge worldwide operation, have done a deal with MGM and an exclusive deal. Others have done acquisitions. DraftKings have gone and acquired some people with their platform. FanDuel is sort of a bit of a reverse case with Flutter, a huge worldwide company, have acquired FanDuel for the brand. But that mix between someone having a strong brand in the market and also having someone who has the platform and the know-how is really, I think it's the model that's going to really work strongly. Now, we're certainly aiming at the tier down from those really big players. We're not aiming at the MGMs or the Caesars. Caesars acquired William Hill in a similar sort of way. We're aiming at that group who don't necessarily have the capital to go out and do a big acquisition, but they want to have, leading market technology and a team who can, turn them a profitable sportsbook and know that they can take advantage of this opportunity that they have with the licenses. So it's really that tier down we're aiming at, which suits us well. We think we can provide them with a unique and competitive product that they probably aren't going to have access to, any other way. If they use an off-the-shelf product, A, it's not going to be unique, but B, it's not having that team that we're going to put in place in there managing it every day.
And Bill, finally, one last question, which is a good question. The esports market is opening up and growing dramatically. Any plans to venture there?
Yeah, look, certainly it's an interesting market. There's a number of different spaces that we're looking around. We've offered esports markets in Australia, but to be truthful, not on a huge scale. Bizarrely, we had a meeting about esports in the office this morning with some of the younger guys who are, a number of our team are moving to the US as part of our expansion, and some of the younger guys there. Certainly, it's probably not exactly my wheelhouse if I'm going to be truthful with you, Tim, but I've certainly chartered some younger guys in the office to go and do some reports on that. And we're actually launching a new range of it in the next couple of weeks. But really, there's an opportunity with it to continue to grow it. There's a big question mark about what importance it will have. Certainly, obviously, there's a market for people betting on esports. Do those people then come and bet on other things? Will they then bet on the football? Will they then bet on the races, and etc.? So, that's certainly a big part of it. For us is, will our other products have an appeal to them, or should we create a niche product just for that market? But look, it certainly is a growth. We've seen, a number of different areas like esports. I mean, things like NFTs with companies like Zrun having, huge growth as well. So certainly we're looking at all those opportunities all the time in this business as we look for, different opportunities in the market as well.
Thanks, Bill. That's all we have time for. Great story. Love to follow up. Have a nice weekend.
Thanks, Tim.
Next up, we have AI Media, ASX code AIM. Market cap around 208 million, 1 year return of minus 11%. The company makes captioning and translation technologies available to everyone around the world, across purposes, across industries, across platforms, and across languages. We have with us the CEO and co-founder, Tony Abrahams. Tony, over to you.
Thanks very much, Tim. We might skip through to slide 3. So as Tim said, we are making the world's content accessible for everyone, and we do that through live and recorded captioning, transcription and translation right across the world. And we might skip down to slide 6, which really is a company overview. Started the company in 2003. Over that period, we have invested, one more slide down, please. We have invested over $50 million in a world-leading technology platform to deliver live captions with very low latency and very high accuracy. We are currently going through a massive technology transformation where we are getting more and more out of every piece of human input combined with the artificial intelligence and machine learning flywheels that are continuing to improve the accuracy of that content, not just in English, but also into dozens of other languages. Since 2017, when we launched live captions with Facebook, that's when our R&D spend peaked. And since then, we've been investing in sales and marketing activities right around the globe. We listed in September last year, and off the back of that have also acquired 3 other businesses, one specifically being absolutely transformational, and that is a business based out of New York called EEG. And I'll talk a little bit more about that as we go through, but really the strategy now is to take what EEG have built in the United States, which is an absolutely dominant position in US broadcast, where they actually manage not just the captions, but the video encoding and distribution for 100% of US broadcasters. And they have very little footprint outside the US. We've been their value-added reseller for the last 3 years. And in the first quarter, where we have actually owned this business, we're seeing enormous opportunity right around the world, taking advantage of those sales and marketing teams that are sitting locally across the globe. So we might click through to the next slide, which really talks about what is our unique proposition here. We are a true one-stop shop for live and recorded captioning, transcription, and translation solutions in what is a growing $20 billion market, and that is growing at about 8 to 9% per year. The really key thing in the technology transformation is in those tiers that you can see on the right. So we now offer a service that ranges from our traditional premium service, and this is something that you can watch on Channel 9, Channel 7, Foxtel, where we deliver accuracy of 99.5%. This compares with out-of-the-box accuracies that you would get from the automated captioning solutions of around 90 to 92%. So we're effectively delivering 1/20th of the mistakes that you would get through one of those fully automated solutions. But the exciting thing is that we ourselves have added automated and semi-automated products that sit on top of that, being Lexi and Smart Lexi. And a lot of the questions is, well, you know, are we going to get run over by Google? I mean, everyone looks at their automatic speech recognition that comes through Siri. It seems to be getting better and better. You know, is there a point at which, you know, our business model ultimately gets consumed by these big tech giants? And the analogy I like to give around that is it's a bit like driving a Formula One car. It's really important to have a great car with a great engine, but the fastest engine doesn't necessarily get you around the track the fastest. And there's a great clip on our website on the Smart Lexi page, which really looks at how the technology of automatic speech recognition can be tweaked and tuned to ensure that it is appropriate for a piece of content. And that's really where we add the smart. So effectively, we're not building the engine. We're actually the ones driving the car around the racetrack. And that requires some maneuverability. And the maneuverability actually comes from teaching the speech recognition engine the context in which it is actually looking to deliver. So for example, if you're looking at a cyclone in Kalbarri in Western Australia, an out-of-the-box solution produces a result which, because it doesn't have that context that there is a cyclone, of a cycling emergency with Halle Berry. And that is obviously something that is completely unacceptable to be broadcast on air. And the smarts that's required to get that out-of-the-box solution to a point where it delivers a much higher level of accuracy is actually a really, really neat little trick. And if we go to the next slide, I'll step you through exactly what some of those accuracy levels look like. So we talked about the out-of-the-box free solutions. That's not the area in which we compete. We deliver that premium level service at around 99.5% accuracy. But where the business is transitioning is towards the Lexi and the Smart Lexi tiers. If we start with the Lexi tier, this is actually taking the out-of-the-box automatic speech recognition engine and providing the context from metadata that's associated with that particular session. So in the case of the Olympics, which we delivered using this methodology for NBC in the US on the Peacock platform, effectively, if you were looking at the semi-finals of gymnastics, the metadata would have all of the names of all of the contestants and then all the terms of art that go along with that gymnastics. What Smart Lexi does, and this service you can turn on 24/7 on Sky News Australia and see how it performs, Smart Lexi builds on Lexi by also providing some human tweaking. And what that human tweaking effectively does is allows in real time for news to be updated. So for example, if when Gladys Berejiklian resigned and suddenly you've got your first press conference with a new Premier, Dominic Perrottet, well, Perrottet doesn't sound how it spells. So you actually have to teach the engine when it sounds like this is how you actually want to put it on. And one of the great things that we've really progressed in the last 4 months is increasing the number of applications that we can spin customers from premium to Smart Lexi. And for a customer, the price difference between premium and Smart Lexi is a 50% saving. And then there's another 50% saving if they can spin down into Lexi. From our perspective, our margins moving from premium to Smart Lexi and Lexi move from about 40% to around about 80%. So it's a win for the customer and it's a win for us and it improves the scalability of the model going forwards. Next slide, thanks. Our competitive advantages haven't changed since the prospectus, and they're fundamentally the proprietary technology that helps us get the most out of these speech recognition and translation engines. Security. We are not a B2C business. We deal with the top end of town right around the world, and we make sure that data is secure. And that can be whether we are getting TV content ahead of time that can't leak, or it could be where we are providing captions and access for important product innovations inside a particular large technology company. We integrate our systems with any particular platform, any format, any device. We offer multilingual everything, and we've invested in that global sales footprint. Next slide. And next slide as well. And just the highlights from Q1, which is really the first quarter of what is a transformational journey out to 2025. We are transitioning our business from being a tech-enabled services business to being a technology company with SaaS-driven revenues. So while the top line grew at 35% versus the PCP, we have managed to increase our margin from 39% to over 50% in that period, driven by that very strong growth in Lexi and Smart Lexi minutes. And we also introduced a new product suite called Sub-Silo. And what Sub-Silo does is it actually looks at the live captioning and provides tools for our customers to use that content to improve value in their organization. And the very first application of that is actually in Parliaments, and I'll talk to that in a sec. Strong cash balance, and we implemented a buyback scheme for up to 2 million shares. Next slide, thanks. A couple of key customer wins. Microsoft Teams we embedded with in the first quarter, We won the New South Wales Parliament contract, and as part of New South Wales Parliament, we'll be delivering live captioning, but also we'll be using that captioning to improve the workflow for the delivery of Hansard, which is obviously a really big expense for New South Wales Parliament. Turned on TVSN Australia Shopping Network, and delivered NBC's Olympics and Paralympics. And we might just skip through to the next slide. Again, the focus on growth here is taking that market leadership position that the US has, that our EEG products have in the US, and taking that global. And then the final slide is just looking at that revenue transition from tech-enabled services, which is where we were 100% last year. We finished June with that tech revenue being 76%, with that services revenue being 76%. At the end of this quarter, it's now 72%. And we're going to see that SaaS and that hardware line continue to grow. And we're forecasting that the services revenue will be less than half of the total as we transition our customers through to these more cost-effective, more scalable software solutions. And I might pause there and take questions.
Thanks, Tony. We've got a few questions. A buyback. We don't normally see tech companies put in place a buyback. What was the strategy around that? Does that kind of limit your ability to make acquisitions?
Well, we don't feel like we need to make any acquisitions in the near term. The EEG acquisition was so transformational that it's really given us a complete one-stop shop. There are no real competitors out there that can install the infrastructure and supply the services at those 3 different tiers. EEG was actually our #1 acquisition target and a real driver for why we wanted to list. Once we listed, they provided us the SIM just 2 months later. And what we're really seeing is actually sales, profit, and margin exceeding our forecast. We're now, strongly profitable. We've got $15 million cash in the bank, and our shares are cheap.
Okay, good answer. So what's your revenue growth breakdown? We've got a question here: organic growth versus that EEG growth and that acquisition.
It's actually become difficult to unscramble the egg. 85% of the sales that we have made since the acquisition of EEG in May have involved both product sets. And a great example of that is NBC's Olympics. This was a US $350,000 sale, which comprised $200,000 worth of EEG and $150,000 worth of what you would consider traditional AI media. None of that would actually have arisen if the companies hadn't merged, because we needed both of those components. So the top line growth that we're seeing of 35% really includes that acquisition. We are also not necessarily focused on that top line, because it's a good news story actually when our customers spin down from the premium to the SaaS services. They're saving themselves 50%, but we're actually getting more gross margin and increasing our scalability. So the number we're really focused on is actually that gross profit growth. We are investing significantly in sales and marketing, significantly in product innovation. And that's really the transition of the quality of the revenue is really what we're more focused on rather than revenue. We haven't put any guidance out in market. We are in a transitional phase as we bed down this acquisition and we look to take on new opportunities in new parts of the world. And I think we'll have more to say on that when we deliver the first half results in February.
And just finally, Squid Games, I haven't watched it, but everyone tells me the subtitles are really poor on that. So can you talk to your technology and how it differs to others?
We didn't do it. That was done by one of our competitors. Yes, that was an absolute epic fail. And it does go to really understanding, those 3 tiers that I spoke about, premium, like when you've got a piece of content that you're investing hundreds of millions of dollars in, why you would look to save $100 an hour by going for a cheap and nasty solution on the captioning, it's going to come back and bite you as it did with Netflix. What we guarantee, and we've done this for years and years and years, and we stand behind the regulation that sits behind the captioning quality for our customers in Australia. They could be fined $420,000 if something like that happened on Australian TV. We've never had an instance of that. What it means is that you need to understand the importance of the content. The more important the content, the higher the level of quality. And that's something that Netflix got wrong.
Good to hear, Tony. Great story. Love to get you back. Have a nice weekend, and we'll go from there.
Thanks very much, Tim.
Okay, next up, we welcome back Trigg Mining, ASX code TMG, market cap of around $10 million, 1 year return of -40%. The company is exploring for the essential potash mineral fertilizer sulfate of potash, or potassium sulfate, which provides necessary nutrients for agricultural production and human nutrition. We welcome back Keren Paterson, who is Managing Director and CEO. Over to you, Keren.
Great, thanks, Jim. This is very exciting to be talking about what we've achieved in the last 2 years since listing.
Yeah.
It's this is an entirely greenfields discovery where there have been no holes ever drilled to date. So it's incredibly important in what we've achieved over that 2 year period. We always thought this was going to be company making. With all of the work that we had done previously to setting foot, and this has proven to be the case. A recent scoping study indicates that this has a potential to be a top 10 global sulfate of potash producer. And this is important because this is an essential fertiliser for global food security, and we need more of it. And it's very hard to find these types of deposits in the natural environment. And for all of this, fits our purpose perfectly because Trigg is all about building mines communities can be proud of. And not only is this a really good fertiliser for global food supply, it's also incredibly environmentally friendly in its production process because we'll be looking at harvesting the potassium-rich brine, so the minerals are already in the water, pump and hypersaline water, so nothing grows in this water, it's so dense in minerals, putting that in evaporation ponds and harvesting solar energy to produce this natural product. So it's very exciting from a purpose point of view as well. If we can go to slide 3 or 4, please. So who are we? You can have a fantastic project, but you need to have a really great team to back that up. And we are building on that as well. Our recent additions to the team are 2 PhDs in chemistry. And this is important because this is about it's not really mining. So we're not going to have an open pit or a rock waste dump or even a tailing storage facility like a traditional mine. This is very much about abstracting the brine. So the principal hydrogeologist who's been working with us right from the very beginning, Adam Lloyd, is incredibly important. And then also understanding the chemistry side of things. So the appointment of Rod Baxter to the board earlier this year and Tony Chamberlain, who both have PhDs in chemistry, is important. Some other takeaways on this slide is our enterprise value. Just keep this in mind as I start talking about what it is that we've discovered out there and the implications from an economics perspective. And that we haven't yet attracted institutional investors, but I expect that will change shortly as they too see what we've done. Next slide. So where is it? We're talking about Western Australia. The projects are in our backyard. Trigg Mining is located in Perth. I studied in Kalgoorlie and have spent most of my operational career in this region. Lake Throssell sits on the Great Central Road, and that's important because the federal and state governments, Western Australia, Northern Territory and Queensland, are bitumising that road to become the Outback Highway. So we're going to have excellent transport logistics with bitumen to our mine gate. We'll be able to transport it then back to Leonora, the railhead, and put the product on rail. But firstly, it would be really great to also sell that into Australia because currently Australia imports all of its potassium needs, and potassium is essential in all living cells, so we have to have it for our agricultural output. And as I said, it's truly sustainable mining. It is solar evaporation of saline brines, and it's a natural product. It can also be certified for organic use. So this is really about the long-term food security of Australia and globally. Next slide. So the scoping study assumptions. So Lake Throssell, we've 73 cents US exchange rate. We've picked what we now believe to be very conservative price for SOP, which I'll talk about a bit later, but that's based on the last couple of years and forecast rates of $550 US a tonne. Our project at this initial scoping stage, where we need to base most of our project plan on indicated resources, is 245,000 tonnes per annum. This is a large project on an annual basis, and that's what sets it in that top 10 global producer. The initial mine life, so this is the very beginning of the story too, and we're already talking about 21 years. Next slide. So what does that give us from an economics? Because it's also important to be sustainable economically, of course. Capital, we anticipate it will take some 378 million to build this, including a 70 million contingency, which we anticipate to refine as we further refine our economic studies on the project. Our cash cost, $250 a tonne, will give us an EBITDA around $97 million a year for every year for 21 years of production, giving us an NPV of $364 million. And importantly, this is a lowest cost quartile producer. So this project, once in production, will be incredibly competitive globally. Next slide. So what will it look like? This is about trenching and bores. The next slide will show you what it's going to look like in the ground, but this is the surface layout of our production target. So 110 kilometres of trenches, but over an area that's well over 300 square kilometres. This is a large project. And starting off with 22 bores, and as we abstract the brine, we'll increase that to around about 112 over the mine life. Next slide. So as I said, this is big. It's up to 36 kilometres long already in our project area, and we've got about twice that length under tenure. It's about 150 metres deep with two areas for production. The superficial aquifer being close to the surface, which we can abstract from that with trenches, and then the glacial fluvial sediments at the bottom. And that's where this big glacial valley has been carved through the landscape and it's full of rocks and gravelly bits, which create the great pore space and then the productive yield for the brine. So it's like a big bathtub, 36 kilometres long and 5 kilometre wide bathtub. Next slide. The site layout, this is also important, how we're actually going to do that. Once we pump the brine, we need to put it into some halite crystallisers, which we'll keep on the lake to minimise environmental impact, but also cost. These ponds will then concentrate right from the beginning because this is such a saturated brine. And then we can transfer it into what we've called there as the KTMS crystallisers. For you and me, that's the potassium-rich, enriched salts that will then go into the process plant for final purification and then packaging for shipping out. Next slide. So the process flow sheet, I won't spend much time on this, but it is quite simple. Most of the projects globally use this very similar process flow sheet. So it's all tried, tested and confirmed technology that will be used to do this. Next. And then there is more to this. So this is just the beginning. As I said, we've been listed for 2 years. This is the first lot of exploration. We announced the maiden resource in May this year for this discovery, but we do have a lot more work to do on an exploration side. So this story is likely to get even bigger. The exploration target at Lake Throstle is around about 2.5 to 9.5 million tonnes of additional material on top of our 14.4 million tonne resource. And that's on strike. So we could potentially expand this project up to around about 70 kilometres long. Next slide. And then at Lake Yo, which is just 35 kilometres to the south, we have some very similar satellite imagery that gave us the confidence that Lake Throstle was going to be a project of scale and grade as it is. Lake Yo is as good, if not possibly better, even than Lake Throstle. And we're working on getting those tenements granted and looking at the further upside, potentially increasing the mine life of the project as well. Next slide. So why sulphate of potash? Well, without it, we just really don't have all of our tasty bits of food. But I need to move on to the next slide, more importantly, because this just reinforces the top 10 and the lowest cost quartile. And then the next slide is something is really shifting in fertiliser industry around the world, and that is prices are really going up. And that's from supply constraints, that's from increasing demand, And we can see here that the sulfate of potash price in the last 3 months has gone from that $550 assumption to now over $800 tonne. And that has a big impact on our NPV. For every 10% increase in price, it will add another $144 million to the project. Next slide. I also just want to touch on what is happening globally in all commodities. And because we hear so much about battery metals and the environmental impact of shifting to electricity, but there's also this need for food, and prices in food inputs and food outputs are really increasing faster than a number of those metals. So you can see there that a lot of the agricultural commodities have gone up quite substantially, and especially potassium fertilisers. Next. I'll just leave that here. That's the project timeline. You can refer that to the online version, but we're about building mines, so that's the plan to get to that final investment decision. And our summary slide is the one that I will finish on. I'll leave that there while I hand over to Tim to ask some questions.
Thanks, Keren. We had an article on potash this year on Share Cafe, and it'll end up being the most popular article that we've had this year. Now, against that, there's been some changes in sentiment in your industry, given the failure of Salt Lake Potash. Can you give us an understanding? This has occurred out in WA. Can you give us an understanding of what occurred in that regard and how Trigg's different?
Look, I think it is a really unfortunate outcome that one of our peers has entered receivership just before they produced their first product. It is a situation where they were very, very keen to get into production very, very quickly, and perhaps didn't assess all of the risks of the project and the technical challenges of what this is about. So Trigg's approach has always been about, we've not been trying to compete to be first. We are making sure that we go through all the evaluation processes really vigorously and rigorously with what we're doing to collect that data and de-risk the project, so we're really efficient with our use of shareholder capital. These projects are really big, it's a long life, it's new for Australia, so we need to develop the IP, and that takes a bit of time. So we really are making sure that we are doing this sensibly and very efficient with capital as well.
And there's a very large CapEx obligation as you move forward. So what's the balance here? You've got you've got debt that you need to take on board to go into production, and then try and secure an offtake agreement. Is that how it should all map out?
Yep, we've already been having some very early conversations with potential offtake partners. We clearly do need to underpin the debt with contracts to sell the product, but I'm really confident based on what the peers have been able to do, but also those early approaches that we've experienced here at Trigg, even before we announced a resource on Lake Throstle. So I'm really confident that the world needs this. I didn't get to talk about really demand and supply very much, but we're just not making enough of this product from a natural source. A lot of it comes from a chemical process, and that is incredibly environmentally taxing. So we need more of this product globally.
And given how environmentally friendly this product is the opportunity to seek debt from some of the environmentally friendly funders?
Yeah, there's been North Australian Infrastructure Fund, Green Energy Fund has supported some of the projects, and it is very much, I think, on the radar for more sustainable investment because of the way that it is produced, but also the impact it'll have on the sustainability of agriculture as well.
And the mine life is 21 years. Could you expand that mine life, do you think?
Absolutely. That's what we expect there with the exploration target at Throstle. We've got more work to do to define that. We're only scheduling 41% of the resource in this scoping study because we need to rely on the indicated predominantly. But as we do some more work next year and increase the confidence in the inferred resource, all of that will expand the mine life and potentially the production rate as well.
And finally, there's a question here. Do you need to do more sampling to be sure of the resource continuity? And can this increase the resource size when completed?
Yes. So next year we'll continue on the now resource definition of the resource that we have now, and that'll increase the confidence and allow us to convert that resource into an ore reserve, which is what underpins the pre-feasibility study. And then we will have, we anticipate that as tenements are granted as well, we'll continue to do some exploration and really scope out the scale, because you need to build the right size project, right size processing plant for this. You can't just keep adding bits to it once you've done it. So you really need to know just how big it's going to be.
Great, Keren. That's all we have time for. Have a nice weekend. Nice to see you again.
Great. Thanks, Tim.
Okay, next up, we have Babylon Pump and Power, ASX code BPP, market cap around 16%, 1 year return of down 44%. The company is focused on the oil and gas and mining sectors, providing specialised equipment rental, experienced operators and technicians, and repair and maintenance of customer equipment, with the emphasis on large diesel engines. We have with us Michael Shelby, who is the Executive Chairman. Over to you. Thank you, Michael.
Thanks, Tim. Thanks for the opportunity. If you can go ahead and click through a couple of slides here. Okay, that's good. Thank you. Babylon is a rapidly growing specialist mining services provider. We're headquartered in WA with operations in West Australia and Queensland, the two resource-heavy states. We specialize in 3 areas, 3 core businesses that we operate in: specialty rental, which is focused on dewatering and temporary power generation; specialty industrial services, which is based off of high-pressure pumping and blasting; and then diesel maintenance services, which is focused on maintenance of large engines and rebuild of complex machinery. The 3 segments are all supported by a shared skill set of our workforce, our shared facility requirements, and our operating processes. We've built the company off the back of having an experienced set of tradesmen and core competencies, facilities, and processes that allow us to touch the client in several different points to maximize value of our investment in our facilities and people and our equipment. We try to leverage our experience and our workforce to be able to, maybe where we have an in with the client for a diesel maintenance point of view, leverage that relationship to then begin to rent equipment or industrial services, and we've been able to successfully broaden our scope across the maintenance purse that our clients have. Again, go to the next slide. Just a quick corporate snapshot. The key takeaways here is the company was founded in 2017, and our first operations were only in financial year of 2018. We started from a very low basis, very low revenue, and we've had tremendous growth over the past couple of years, underpinned by, I guess, the past couple of quarters. We've had tremendous revenue growth and operational cash flow growth, operational cash flow positive. And the other item is we have one significant shareholder who acts as a strategic advisor to the board. Entities controlled by Jeff Lord. He's been as a significant shareholder since the beginning and has supported the company throughout the acquisitions that we've made for growth. We're still a small guy. We have a long way to go in a very large industry. Go to the next slide. I'm not going to go through the entire team, but as I have released in the past couple of weeks with our operational updates, we've gone through a rejuvenation of our executive team. And with that, it's been a bit of a growth story, whereas early days, very entrepreneurial and having skill sets and team members there for explosive growth. We're now transitioning in more experienced, larger business types to really underpin the business for future growth, where we're embedding processes and business practices to improve our profitability. We've also been fortunate in that the past week, we welcomed on a new independent non-executive board member, Ms. Louise Bauer. She's come in to complement our existing board with another resource experienced background to be able to underpin our future growth. Next slide, please. It's been a quick journey since 2017. We were founded. We relisted in January of 2018, again off the back of very low revenue. But in 2019, we completed our first acquisition of Prime Power Queensland, which gave us operations in Mackay And that's been a significant investment on the diesel maintenance side of the business. It's brought forth a tremendous client base on the East Coast, allow us to diversify a bit. In 2020, we were able to embed the acquisition, provide positive EBITDA, and really start to grow our market presence. We completed our next acquisition, Ozblast, in March of 2021, just this end of this past financial year. And with that acquisition, our major finance provider, NAB, has been on board to grow with us, and they gave us another round of financing package to be able to support our future growth. We closed the year with significant revenue growth, and we've actually then now opened up the next quarter off the back of that growth to continue going in the positive directions. Go to the next slide. We're a small company, but we deal with the big guys. Our largest clients are BHP, Rio, FMG, Alcoa. Efforts over the past 6 months have resulted in greater spread across the commodities. Iron ore and coal still dominate our client base, and that's what got us started. But we've been successful over the past 6 months as we transitioned into larger opportunities in alumina, bauxite, gold, and lithium. Again, having various touch points, various business segments, we're able to approach a wide suite of clients to be able to get a foot in the door and then bring the other services we provide in and grow into those areas. We've made a conscious effort to try to spread both our mineral base and our geographical base. Currently, revenue is split roughly 60-40 East Coast, West Coast. And although iron ore and coal still dominate with greater than 50% in total for those two minerals, we're starting to see tremendous growth in the other areas. And that's something that our team still continues to push. And for us as a small company, we don't want to have all of our eggs in one basket, and make sure that we're able to kind of spread our risk across the commodity sectors. Next slide. This past financial year, I guess, consumed a lot of effort and a lot of hard work to try to position the growth of the company going forward. The work that was done in 2021 that'll benefit going forward was acquisition of assets for our specialty rental division. Those assets have been deployed at a great extent now here in 2022, in the FY 2022, and we're starting to see revenue in various new client sectors for those. So we're quite happy with that. We've also, a lot of effort went into the acquisition of Ozblast, and it's driving growth in the higher margin industrial services area. That is a standout area for us, and we're positioning ourselves to truly try to grow that with bringing on a dedicated business development person in that business, and really try to push the higher margin services back to our existing clients. We're very excited. There's lots of opportunity with that business, and we're seeing a tremendous engagement with clients, and we're expecting some key wins to come through for the calendar year 2022 going forward that'll really solidify what we're trying, our efforts in the past couple of months. And then lastly, in this past financial year, we invested quite significantly in a service exchange model for our diesel maintenance business. That business consumes quite a bit of cash and a lot of effort to build up the service exchange engines. Those engines really position us for a quick turnaround for client needs, so we're able to dispatch engines quicker. And then also it positions us for recurring work, because as we are able to provide clients with engines in a very quick basis, they reduce their downtime for their machines, and also we get their return engine coming back, which leads to the next piece of business and the next piece of business to roll forward. We feel like that investment has brought recurring opportunities, and we're starting to see the payoff here in this past Q1, and we're starting to see it going forward as well through the year. So we're quite happy with with that investment and with the efforts we put forth there. Next slide, please. You can go ahead and skip again. Growth prospects. Rental will continue to focus on the longer-term rental opportunities. Our business focuses on the complex dewatering and temporary power provision. We're not a off-the-shelf rental type company like a Coates or an On-Site or those type guys. We tend to focus on the more complex installed base that kind of gets more ingrained in client sites. It takes 6 to 12 months worth of work, worth of commitment to the client. We're continuing to push that as we grow our asset base. We're getting uptake there. We now have assets deployed and people on site maintaining those assets and acting as a service provider for dewatering at multiple sites throughout WA. We feel like we're well positioned there, and we have a plan to continue to grow our rental fleet, and we have some capacity within the existing capacity within our financing with the banks to be able to grow that business as well. Next slide. Diesel equipment maintenance. Like I said, we have multiple maintenance contract opportunities we're working through with clients, and these are off the back of the service exchange program. Investment in these large engines has allowed us to focus on recurring works, and as we've won those projects, we're now getting ingrained in clients' future diesel maintenance schedule where we have visibility. So we're becoming less of a reactive company and much more of a proactive service provider where we're ingrained with the clients. We feel like that visibility has allowed us to invest in the people and in the facilities that we need to grow there, and we're excited with what's coming in the pipeline in our sales funnel with the opportunities we're being asked to address. We're transitioning in the diesel maintenance area from a small provider to a medium-sized provider. Our largest competitors are the likes of a Westrac or a Hastings or a Cummins, the OEMs, and we're moving away from the small reactive shops towards the big end of town. We have a long way to go, and we don't really want to be that massive provider, but being that medium-sized business, we're able to provide the clients with what they need and the proactive solutions with the service exchange program, but also a bit more oomph behind us. Next slide. Especially industrial services, the Ozblast acquisition, the growth prospects there are tremendous. We're making a tremendous effort there to push with sales and marketing efforts, and also being able to use our contacts across our existing clients to push those services into the market. That business is the highest margin business for us, and that's what we're trying to continue to drive forward and see that as a tremendous growth opportunity going forward. Next slide. We have ambitious goals. We want to have a large scalable company. We want, again, lofty goals, 100 million plus profitable turnover in the next couple of years. That'll come through both organic growth and acquisition opportunities. We have a plan with our existing businesses to get us part of the way there, but we will also look at the right opportunities as bolt-ons going forward. Next slide. The outlook, in summary, the key drivers haven't changed for us. This is a massive market, and we're still a minnow in the massive market. So there's lots of opportunity for us to build a business and build a nice, profitable business off the small bits that the big guys overlook. The demand for specialty services and rental equipment will continue to increase. We operate in operating mines. We're not dependent on greenfield opportunities, and as long as people are moving ore, we need to be, our services are required. COVID restrictions actually help us with lengthening of lead times for specialty equipment in the country, and being a service provider set up with all the majors, we're there as an alternative where other larger organizations may struggle with people and the ability to get the work done. We're a bit more nimble and able to come in and fill the gaps. There is a high barrier to entry for other operators. We feel like we've been through the hard work so far in the past couple of years, and we feel like we're well positioned. Our workforce is locally based. We're only just over 50 people, but they're based in Queensland, they're based in WA, and we have a core set of skills in our workshops, which we're extracting value of. And we're very fortunate we have a supportive lender in NAB who continues to work with us on our growth. One more slide. And I'll leave it at that. And Tim, if you have any questions, I'm happy to give them a crack.
Thanks, Michael. We've got some questions. Electrification is a theme here in terms of the questions replacing diesel machinery. How do you adapt with your workforce?
Well, we do quite a bit of work right now with the electric driven trucks, and that's not the true electrification like you're talking about, but electric driven trucks use a big diesel engine to drive the alternator and actually drive the truck. So we're doing that work now, but even with the true electrification, mechanical parts require maintenance, and whether it be an engine, a transmission, a wheel end, we're doing those critical bits. And whether the power might come from electricity or by burning diesel, there's still the moving parts that need our services.
And there's a question further on that theme in terms of hydrogen and the critical minerals sector. Can you adapt and move into those areas as well?
Yes, because of the specialty nature of what we do, being involved in the engines, and that's our core competency is the big diesel engines. We're starting to have some involvement with guys who are wanting to use hydrogen and other alternative fuels. You need people who are nimble and open-minded to be able to work with them, to use our knowledge and our capability in our workshops to be able to support that transition. Because the big guys, yes, they will invest in it. Yes, they will go that direction, but they have a much bigger ship to turn.
And where do you see the most growth potential within your existing businesses?
Pure dollar wise, the diesel maintenance side it's a massive business there. But from a profit point of view, the specialty rental and the industrial services is what we're pushing. We need the critical mass, and we want the critical mass of the diesel maintenance business that underpins the business, that helps us have the nice recurring work for our staff in our facilities, but the growth and the profit growth will be through the specialty services and the specialty rental that we do.
And finally, how advanced is the new Perth workshop?
We're hoping to have it ready at the end of the financial year. It's a purpose-built facility. It will allow us to significantly increase our capacity, and funnily enough, talking about it, it's starting to attract workforce, because guys always like to have a shiny new workshop that's purpose-built for what they do. So we feel like the stars are kind of aligning to where we'll have something exciting here at the end of the financial year to step into the next financial year and really hit our growth strides using that facility.
Great, Michael. That's all we have time for. Have a nice weekend, and we'll get you on probably next year.
Okay. Thanks, Tim.
Thanks for your time. That's all we have time for. Watch out on Tuesday for the CASIA due diligence webinar, and we'll see you then.